All right, we're in the red today, giving up some earlier gains. All three major indices struggling to recover losses from Monday's sell-off, or at least to back up the gains of yesterday. A few bright spots, though, within tech today. Apple's leading the pack. Amazon and Alphabet are still green as well. You see what those stocks are doing at this moment. My next guest holds all of them. Says now's the time to buy the dip, too. Joining me now at Post 9, Rich Saperstein of Treasury Partners. Good to see you back here. So your phone must have been going crazy on Monday. Can you just give me, we said that you're one of the top 5 advisors, right, ranked by Barron's. So can you just give me an idea of what this week's been like for you?
Well, my first experience with an eye-popping decline like this was back in '87, and we've seen many of them since then. And we've developed a playbook to deal with all this and guard client capital. And it starts with the catalyst. And the catalyst here was really a disproportionate decline in the market relative to the tepid economic data. So lightly caused because we're at 22, 23 times earnings. And really, it's the type of volatility we're going to experience going forward. Now, my phone rings, and it's really about asset allocation. It's about the move we made last year where we allocated to long-term tax-free municipal bonds at 4.5%, and clients wanting to be opportunistic and possibly reallocating back to the stock market.
Were you a buyer on Monday?
No. We think about an old concept called 2 steps and a stumble. And so you have a market, we still fully invested, but you have a market which goes down, there's some decay, there's some issues, there's value, but I'd like to see things settle out first before we start committing more capital.
Do you think mega cap tech, which we're showing on the screen right now, and we said that you own a lot of these names, does that need to, in your words, settle out more?
Yeah, I'd like to see that, but we still like the stocks. I mean, where do you find, let's take Google, Microsoft and Amazon's cloud business. They do $100 billion a year, grew 30% quarter over quarter. Now, a $100 billion business would be a S&P 35 company growing 30% a year. So many investors are underweight large cap tech. And that's really where the opportunity is for investors who do not own enough of these names. They should have an exposure to them.
When you say investors don't own enough of these names, what kind of investors are we talking about? Because it feels at this point as though everybody owns these names.
Not really, because there's a lot of investors that are underweight large cap tech. And so they might have biotech or other exposures, small cap, mid cap, international. And really, it's very important to understand where there's growth of cash flow and where there's opportunity in the market, and it happens to be rather concentrated right now. What
about valuation for these names? Top of the program today, I read the list of how much valuations have come in as these stocks pulled back from July, double-digit percentage point declines.
No question. Values are stretched. Market's price for 15% earnings growth year over year. And that's the reason why we're seeing all this volatility, which should continue throughout the year.
Wait, you mean valuations are still stretched?
Yeah, still.
In these stocks?
Yeah, so we look at the cash flow and the growth of the cash flow, but multiples are stretched in these stocks, and there's still a lot of pockets of opportunity in the market right now.
Okay, so where is that?
Well, we have been adding to 2 utilities. Okay, we started with. The thesis on utilities is long-term secular increase in power. And we're underpowered in this country. So we own 2 names, NextEra and Vistra. We've owned Vistra since 2021. It's a $25 billion company, $4 billion in operating cash flow, $2.2 billion in free cash flow, returning it to shareholders. And keep in mind, our utilities are in 2 states that have net immigration, population immigration, Florida and Texas.
But when you are highlighting utilities, that screams defensive. Is that what you think the best strategy is right now, is to be defensive? If you're going to buy anything, to buy those types of stocks?
Well, when you look at a portfolio of 20 to 30 stocks, and you've got to broaden out your names, one sector we really didn't have exposure in was utilities. So we just added NextEra. We've been a long-term holder of Vistra. But think about the cloud. Think about AI and the concentric rings of opportunity around it. So think about services, Accenture and IBM. Think about the power generating that, so the utilities. So there's a lot of opportunity if you just look past the core cloud providers, like the big four.
What's a reasonable valuation, do you think, for the overall market? If, people were suggesting 21 times was just way too expensive relative to where earnings were really going to come in, what seems more reasonable, and how far away are we from that?
Historically, 16, okay? But now what you...
16?
Yeah, that's historically. But now that you have a concentration in large cap tech dominating a third of the market, selling at higher multiples with higher growth rates, you've got to raise that higher. So where we are at 22, 23, a little stretch for me, but we still own the stocks and we're still fully invested.
What about bonds? The attractiveness of them today, given rates are coming down. Now, obviously, they've bounced back up. Mm-hmm. But what's your take there?
Look, last year there was a tremendous opportunity to add 4 to 4.5% tax-free long-term munis,
mm-hmm. and which you did.
Yeah, we bought a slug of them. Right now, that's down to a 375, 360 yield. So the bonds have gone up in value. Mm-hmm. I think one of the biggest mistakes was just laddering 3-6-month treasuries and getting that 5.8%, because now that rates are coming down, what do you do with that money? So right now, what we're doing is we're adding housing bonds. We're still able to achieve over 4% in tax-free housing paper, which is still an amazing opportunity. You're subject to call risk. And other than that, we're buying more 3 to 6 year paper, both on the taxable and the tax-free side.
It's good to see you again. Thanks for coming by.
It's my pleasure.
Rich Saperstein, Treasury Partners.